moving on to a little bit more of the indicators on things that help you make better informed decisions are inflation and also the yields on 10 to 20-year treasury bonds. And if you don't understand this very much, here's Elihu to impart some of that knowledge.
So inflation happens when a lot of money or government spending just enters into the non-government side of our system, and it's all been just printed, mainly to support Americans. I mean, we're seeing stimulus checks, and all that money leads to inflation because now that there's more money in the playing field,
people are spending more,
and
that jacks up prices in a sense because there's more demand.
Right? You need, and there's still the same amount of supply. So a good indicator for markets is when we start seeing inflation rates increase, and then the treasury bond rates.
Yes, the yield on the treasury bond, which is basically another word of saying the profit or the amount of money you'll get paid out each year for holding this bond.
Right. Those are good indicators because that means that the government is trying to get you out of the stock market and into bonds because they're going to offer slightly better returns.
And it's safer because it's the U.S. government who's paying you, or the U.S. Treasury or the Fed. In a sense, they're not one entity, but they kind of play in such a way that there's a lot of security. So when you get a raise in interest rates, that is also a raise in the profits that you receive on holding these bonds. But right now, we are dealing with record low interest rates. And that reflects on the yield that you receive on bonds, but also the amount that it costs somebody to borrow money, say for buying a house. And that's why you're seeing interest rates for buying a house or borrowing money for mortgages go down at the same time.
Right. And so treasury bond rates are synergistic to the rate of inflation. So the more inflation there is, the higher
or the lower the yield.
The lower the yield, the more inflation. The lower the yield, the more inflation, and as an effect of high inflation, the higher the yields in treasury bonds.
Well, typically, it's not so naturally occurring. It takes the Fed, typically the entity involved in handling monetary policy, it takes the Fed to kind of come in and decide whether they should raise interest rates to slow the rate of inflation. Now, right now, let's see inflation, Fed, and we'll pull that up, just the rate of inflation, but we're around like 2.5%.
Which is not bad, considering...
Oh, I'm sorry, I think it's 1.5. Let me just pull it up.
Even better, which is not bad considering how it's stayed pretty consistent, considering a lot of the money that has already entered the market or the non-government side of the system. So,
yeah, 1.2% as of November.
1.2. That's not bad.
Yeah, it's not bad. I mean, they wanted to be at 2.5. It just means that, like, you can see here, it just means that people, they stopped spending a ton of money during April, during the beginning of the pandemic, and then they started spending more and more, and that started raising inflation, bidding up prices and whatever.
Yeah, so, like, I mean, if more people want Gucci flip-flops, then the price of Gucci flip-flops are going to increase because, I mean, not only is there more money in the markets because of the stimulus checks, I mean, I don't know where your $600 are going, but mine are going to Gucci flip-flops. But, the government isn't raising interest rates until 2022, so that's going to affect inflation even more.
Well, Kathy Wood, interestingly enough, one of the CEOs and chief investment officers of ARK Invest, a very prominent hedge fund that has gained much attention from the media and also juicy returns from its investment in Tesla and other innovative companies in the bio engineering space like CRISPR and what have you. She says that with the rate at which the government is printing and injecting money in the economy, that we're likely to see the Fed react adversely and say, hey, this is not sustainable. We're going to have to cut back on quantitative easing, which is basically buying, bad debt from banks. Just simply put, this is the basics. Don't rail on me in the comments, but it's just a very simple way of saying that the Fed might raise interest rates in order to slow the rate of inflation, because we're at 1.2. I mean, we're basically in January right now, so this is a couple months old. So we'll get the new numbers soon if they haven't come out already. But if they're above 2.5% and later on in the year, the Fed might begin to notice that it is unsustainable. Let's see what the forecast is. So the forecast is an upward sweep, as the Fed is projecting. So between 3.5% and the, 1.75, let's say, if you're looking at this in that range, they might raise interest rates, and then that makes money more expensive to borrow. But then that incentivizes, like Elihu said earlier, incentivizes investors to move out of stocks and go into a safer investment like bonds, where they might be getting paid a little bit more, and it's just secure, and it's just a safer way to put your money.